Let's now move on to the markets. Trading on the floor of the NSE saw the NSE All-Share Index closing at 36,143 points, gaining about 0.25%, with a total of 4,241 deals in the market today. Gains were seen in Nestle, Guinness Nigeria, Okomo Oil, Total, and Nigerian breweries, while leading the market declines were CAP, Mobile, UAC, Ashaka Sem, and Jos International Breweries. Babajide Sholanke, Research and Strategy Analyst at FSDH, joins me now to talk us through the NSE's performance. Jide, are you surprised that the market is holding up very well after the MPC decision? Clearly, we are still in a very tight monetary policy environment. A lot of people talking about foreign investors coming back to the market, but I'm not sure we're seeing that just yet. Your thoughts on the market's performance today?
Thank you, Wale, for having me. Good afternoon. The market performance today is not surprising, because if you look at the historical performance of the market has done well, and it's only rational that there should be some kind of portfolio rebalancing. We've had a spate of bearish run, and some prices are looking attractive again for investors to come in and take advantage of another somewhat bull ride.
All right, and talk us through what you think are your best ideas in this market. A lot of people saying that the market is not likely to really move significantly this year. I wonder if you agree with that stance, and if so, how do you invest in this market right now?
Yeah, I shared the sentiment of those people that you spoke with, that share that idea with you. I do not expect any significant gain in the market, of course, but we will see intermittent gains and profit taking as we move on to close the year. One thing we must always remember is that the market has done so well year to date, and and if you look at most stocks in this quoted on the floor of the SR, about half of them have beat the market index itself, which is the NSE All-Share Index. So going forward, the portfolio strategy is for you to begin to take advantage of fundamentally strong stocks, particularly stocks in the consumer spaces as we enter into the festive period, into the festive period of the Muslim celebration of Eid al-Maulud. I'm not very sure what it's called now, and the Christmas celebration. So defensive stocks in consumer spaces, and some banking stocks will be a good strategy going forward.
Let's focus on the banks for a little bit. Of course, there's some news around First Bank investing in Ghana. It's in line with their strategy to invest more across the continent. What's your take on First Bank right now?
My take on First Bank is a buy for me. It's a buy because of a strong balance sheet and the need for it to grow its risk assets, given that there's not much opportunity in the government securities, which most of these banks have made a lot of money from. And I think it's the right strategy. It has a very robust balance sheet, and the African space beacons on them to invest. So I expect Nigerian banks, as they've been doing, and it's not new, most of the Nigerian banks have been having African reach. There's so much intra-African trade, inter-Africa investment between the Nigerian banks and African regional banks. So the best thing for the banks to do now is for them to begin to look inward, begin to look for ways to be creative, for them to increase their risk appetite. And you can see that First Bank is leading the pack now in recent time, among the banks, to increase its risk appetite by diversifying its risk across the African continent.
Right, but I get the sense as we moved on this year, a lot more negative sentiment around the banking sector. I wonder if you share that sentiment as well. Are you bearish about some banks right now? Do you think some banks are likely to struggle in this environment, or are you still bullish about and stay with that investment case about the low PE ratios, the low price to books, that banks are essentially where one should be investing in Nigeria right now?
Yeah, for the banks, a double whammy. Double whammy in the sense that if you look at the sense that a lot of people do not expect the banks to make much from investing in government treasuries and government security because of certain policies that were made by the central bank. But if you look at it again, the tight monetary policy has created a scenario in which we should expect fixed income investment and fixed income, use on fixed income to remain very robust and to compete with return on equities. But however, given the current monetary policy style of central bank, which says that there's huge structural liquidity, excess structural liquidity in the banking system, and the slamming of the 50% CRR of the banks to reduce the public sector fund. And it's not too far-fetched, because when you look at historical NIBOR rates and look at historical NIBOR rates, vis-a-vis government finance in terms of distribution of revenue to the federated units, you find out that anytime the FAC allocation comes in, there's a very close and positive relationship between government finances and the NIBOR interbank rate. To go back to your question again, I think some banks will be stressed. Stressed in the sense that because some of them, about 2 or 3 of them depend hugely on government finances, on government fiscal operations, on government placing money with them. But however, I do not see that as a significant that will take them out of business, because it's only 50%. only, I use that wisely, only 50% of government deposits that's been taken away from them by cash reserve requirement to go to the central bank. Of course, there will be stress points, but if it's 100% that's taken away from these banks, we will have crisis. But as a way, they will need to struggle in the sense that they will need to be more critical, say, good at risk assets, go out there, invest in the ongoing agricultural reform agenda of the government, invest in the power sector reform, and grow the balance sheet. But going forward, some banks, the traditional big banks, will not have major problems in growing their risk assets and in being creative and coming and going inwards to create assets to generate earnings.
All right, thanks a lot for those perspectives. Well, a final word on the cement sector. Dangote Cement, of course, dominates everyone in that space. How bullish are you about cement stocks right now?
I'm bullish about them because there are indications that the federal government will begin to release the budget allocations for capital projects in Q4 2030. And of course, that means that there will be some building projects and some capital expenditures that will be made by the government. And of course, the cement industry will benefit from that.
Well, let me get your thoughts very quickly on this point. Next year, of course, just before an election year, and the build up to that, there's a lot of spending. What does this mean for stocks, and which stocks, in your view, would benefit the most from all that activity?
When you say that election spend, you have to be very careful.
Pre-election, of course, yeah.
Pre-election spend, you have to be very careful. Because the pre-election spend in itself, the central bank governor did mention in the communique that he reeled out to the public that there's a dollarization of the Nigerian economy because of politicians, turning around the dollar, increasing the huge demand they've been seeing in recent time is not import-based, it's based on demand from people that they're suspected to be politicians. So in that in itself, it has no benefit to the Nigerian economy because this money is being taken for spending, for patronage, and for rent-seeking purposes. So I do not expect the pre-election spending to significantly impact, the equities market. Of course, you can take that data back and see that the equities market somehow is kind of divorced from electioneering campaign and etc. But however, the major significant risk factor for the Nigerian economy going forward, in terms given the positive macroeconomic environment, benign inflation rate, comparatively robust economic growth projections for the Nigerian economy, is the political instability and the political crisis that can come, as we approach 2015.